Welcome to video 2 of part 3 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here back with you to discuss representation before the IRS. In video 1, we learned that as an EA, you can represent clients before the Internal Revenue Service. But what does that really mean and how do you go about it? This video and the next will go into the nitty-gritty about representation. In this video, we will discuss the following topics. First of all, we will talk about the power of attorney. Next, we'll talk about the preliminary work that you need to do when you are representing a client before the IRS. Then we'll talk about the taxpayer's financial situation and how that impacts your representation. Then we'll talk about legal authority and references. And finally, we'll talk about some related issues. Our free resources, you're going to see these first two, Circular 230 and Publication, on all 4 videos in part 3. And in video 1, I told you how important it is that you get those 2 and read them. And then for this video, we're also looking at this Form 2848, the power of attorney and its instructions. I definitely recommend you get that as well, and we will be looking at that form in this video. Speaking of, let's talk about the power of attorney. As we said in the previous video, a taxpayer can represent themselves before the IRS. However, they can also authorize other individuals to represent them. And for our purposes, we're talking about tax practitioners. So a power of attorney is a taxpayer's written authorization for an individual to receive that taxpayer's confidential tax information from the IRS and to perform certain actions on their behalf. As long as the authorization is not limited in any way, then the individual that they appoint, the representative, the EA, the CPA, the attorney, they can generally perform all the acts that the taxpayer could perform except for endorsing a check. Remember, we said that you don't ever do that. Or signing an income tax return on their behalf. Usually, there are some exceptions to that we will talk about. But usually, when you have power of attorney, so your client is going to fill out this power of attorney form, the Form 2848, they are going to name you specifically as their representative. And then they're going to sign and you're going to sign. And then you send that to the IRS. And then once you do that, you can essentially act as the taxpayer for most purposes when you are interacting with the Internal Revenue Service. So instead of the taxpayer having to do everything, having to talk to the IRS, having to go to conferences with the IRS, they can still go if they want to, but if they want, you can just go instead, or you can be there with them. So think of it as if in a non-tax setting, you are hiring an attorney, the attorney essentially can act on your behalf. So that's what this is saying. It is a power of attorney. So it is giving you, as a representative, the right to act on the behalf of the taxpayer for most purposes. Again, you still cannot negotiate a check or redirect their money into your bank account. That's not allowed. And then usually you cannot sign a tax return on their behalf unless it is for one of those few exceptions that we will talk about. So when you, as a representative, have a power of attorney, you can do specifically the following things. You can represent the taxpayer before any office or employee of the IRS. You can sign an offer or a waiver of restriction on assessment or collection of a tax deficiency, or a waiver of notice of disallowance of claim for credit or refund. Those are things that sometimes come up when you are negotiating with the IRS, and you are allowed to sign those things on behalf of the taxpayer. You can also sign a consent to extend the statutory time period for assessment or collection of tax. So again, sometimes when you are in the middle of a negotiation, it might be that the statute of limitations is about to come up. And we're going to talk about the statute of limitations later in this video. But it might be that that's about to expire. And so you're negotiating with the IRS. Sometimes you can actually sign on your client's behalf an extension of that period of assessment or collection of tax. It's a give and take in the negotiation process with the IRS. And then you can also sign a closing agreement. So when you have any type of audit with the IRS, when you get to the end of it, you negotiate back and forth, and then you finally come to an agreement. And of course, you're going to be communicating with your client throughout that process. But when you finally get to the end and everyone agrees that, yes, this is what we are going to do, this is how we're going to settle this matter, this is called a closing agreement. And if you have power of attorney, you can sign that closing agreement on behalf of your client. As we said before, even with the power of attorney, you usually cannot sign an income tax return unless you meet these two criteria. You have to have both of these. First of all, if that signature is permitted under the Internal Revenue Code. And secondly, if the taxpayer specifically authorizes you to sign that return. So you have to have both things. It has to be permitted under the tax law, and the taxpayer has to specifically authorize it. So we'll look at the Form 2848, and there's a box that they have to check that says, yes, in addition to everything else, I do give this practitioner permission to sign a tax return on my behalf. So when does the Internal Revenue Code give you permission to sign the return as the representative? Here are the most common examples. In the case of disease or injury, so sometimes the taxpayer is not physically able to sign the return, or they're not mentally capable of signing the return. So in that case, the Internal Revenue Code would allow you to sign on their behalf as long as you have the power of attorney. Continuous absence from the U.S. for at least 60 days prior to the required filing date. So they're out of the country, they can give you permission to sign on their behalf. And it doesn't matter why they're out of their country in this particular circumstance. And then finally, for other good cause. So this can be just taking into account situations that really can't be foreseen, but the IRS might grant you as the representative the right to sign for the client in specific circumstances, as long as, again, you have got that permission to do so from the power of attorney. So now let's talk about this Form 2848. And it is very important that you fill it out correctly and that you follow all the rules. So you want to get those instructions and make sure you are following the instructions very precisely. If you don't, it is very likely that that form will be rejected by the IRS. And so the power of attorney will not be in effect. So a lot of times, like if you're dealing with tax returns, sometimes you make a simple error or a simple mistake. The IRS will either overlook it or they'll just simply send a letter saying, hey, you made this mistake. We adjusted your tax return, and then you're good to go. There's really nothing else you need to do. But that's not the case with the Form 2848. If there's something wrong, they will simply reject it. And then your power of attorney is not in effect. And sometimes these can be very time sensitive. You need to get this power of attorney done because there's some deadline approaching. And so you need it done so that you can respond on behalf of the taxpayer. So you really can't afford to make a mistake and have the IRS reject your power of attorney. So you want to make sure that you are filling it out correctly. As we said in the first video, only individuals can be representatives, not firms or companies. So if you work for a tax firm, they can't just name your firm as the power of attorney. It has to be your name individually or somebody else's name in the firm individually. And it can be more than one person in the firm. It just can't be the firm itself as an entity. Whoever is being named, so you, let's say in this instance, you're going to have to put down your name, your address, it's your business address, your PTIN, your telephone number, a fax number, a CAF number. We'll talk about the CAF number later if you have one. You have to put all of those things on the 2848. And then the acts that are authorized must be specific. So we'll look at the form here in a minute, but you wouldn't just want to put down that this representative can represent me for all of my tax returns for all of my tax years. They don't allow that. you have to specifically say which returns are you as the taxpayer giving this representative power of attorney for, which returns, like a 1040, for instance, or a 1065 or an 1120S, whatever the form number is, and also for what year. So you don't just say they can represent me for my 1040 forever. You would say 2021, 2022, whatever the years are. You can put more than 1 year. You just can't leave it open-ended for all years. The 2848 has to be signed by both the taxpayer and the representative. And if you are filing this form through the mail, then the signatures have to be handwritten. They can't be electronic. If you are filing it electronically, then they can be electronic. So you may be familiar with these companies like DocuSign, where you sign your name, quote unquote, electronically. Well, you can do that on the 2848 if you are filing the 2848 electronically. But if you are filing it through the mail, then the signatures have to be handwritten. And this is one where they will reject it. I've seen this happen, where you try to use an electronic signature and then file it by mail, and the IRS says no. And now you've just wasted a whole bunch of time because, of course, the mail takes a few days. It's going to take a few days in each direction. And so it can really put you behind the 8 ball. Now, you might say, well, why would you file it through the mail? Why not just do it electronically? Well, sometimes you are getting a letter, the client is getting a letter from the IRS, and then you as the representative are responding to that letter. And the way you respond to those letters is generally through the mail. You can do it via fax, but it's usually better to do it through the mail. And even if you do it through fax, you still have to have handwritten signatures. So either way, you have to have handwritten signatures. So you are responding to the IRS's letter on behalf of the taxpayer. And what you do is you put a copy of the 2848 in with that response. And so you are filing it by mail. So you just want to make sure you have handwritten signatures in that case. Now, a copy or a scanned version is fine. So you can send it to your client via email. They can print it out, sign it, and email it back to you. That's okay. It doesn't have to be an original signature, but it does have to be a handwritten signature. And then finally, any authorized officer can sign on behalf of a corporation, and any authorized partner can sign on behalf of a partnership. So let's look at the 2848 in some detail. So at the top, it's just the taxpayer's name and their either social security number or EIN. Then you're going to have the name, the specific individuals who are named as representatives, and their address. And then you've got their CAF number. Again, we'll get back to that. Their PTIN, telephone number, fax number. If, since the last time that representative was named on anyone's power of attorney, if their address, telephone number, or fax number has changed, then you would check the box to let them know so they can go into their system and update that information. Then you can see this checkbox here, check to be sent copies of notices and communications. So up to 2 people, you can check the box, and anytime the IRS sends the taxpayer a letter about whatever issues we're talking about here, they will also send that letter or that communication to the representative. So it's a nice way for the representative, the practitioner, to be kept in the loop about things. So you're not having to rely on your client to receive this communication from the IRS and then forward that to the practitioner. This way, both the client, the taxpayer, and the practitioner will get a copy of whatever the IRS sends, but only up to 2 people. So you can name multiple people as power of attorney. For example, different people from a firm, but only 2 of them, you can check the box for them to get copies of this information. Then as you come down here, you can see these are the acts that are authorized. So this is where you're going to say, and it gives you examples here, what it is the client is giving you power of attorney to represent them for. So you might say income tax, form number 1040, years 2021 and 2022. Or maybe it's just 1 year. Whatever years they're giving you permission for, you would put those in here. And you can see you can have more than one thing. So it could be that they're letting you represent them for, let's say it's a business return, and you're representing them for income tax. It's their Form 1120S for a certain year. And you're also going to be representing them for payroll tax. So you might say payroll tax, Form 941, for instance, and then whatever the years are. So whatever issues have come up and you are going to be representing that client for, you fill that in here. And again, you need to be specific. You can't leave it open-ended. And then you have this, we'll talk about it a little bit later, but there are some times where you're just doing a very short POA for a very specific reason that you would tell them, do not update this CAF, the centralized authorization file. You would check that. Then you get down here to additional acts authorized. So this means in addition to everything else, a power of attorney automatically gives the representative the authority to do. The taxpayer is also giving them the following authority, and this is where you would say sign the return. So this is where they would be saying, yes, they can sign a tax return on my behalf. Now, remember, you got to not only have this, it also has to be allowed under the Internal Revenue Code, but you have to have both things. So this is where they would do that. You've also got some other things that they can authorize the representative to do. So one of these is to substitute or add representatives. So if you've got a firm with multiple people, this gives anybody listed up here the right to substitute new people in. So sometimes people leave firms, and so you're going to have a new person come in. So this allows that practitioner to substitute a new person in for somebody else that's listed up here. And then there's just this other acts authorized box. So if there's anything that's not listed here that the taxpayer wants to give specific authority to do, they can list that there. Then we go to the next page. And this allows the taxpayer to list specific things that are not authorized. So they want to be clear that, hey, I am not giving this representative authorization to do fill in the blank. And they can put anything here that they want to put there. Retention or revocation of prior power of attorney. We will talk about this later. But if there's anybody else who already has a power of attorney for the same matters in the same year, once you file this power of attorney, that is going to automatically cancel the prior power of attorney unless you check this box. And so that's what that box is for. And then you get to the taxpayer's signature. So this is where they would sign and date. Then we get down to part 2. And this is the declaration of the representative or practitioner. This is you. And so when you sign this return, you are attesting to all these things, basically saying that you have got a valid credential and you are not disbarred and you are allowed and you are okay to do this authorization. And then you are going to say, I am one of the following, and you can see attorney, CPA, enrolled agent. So of course you're going to be an enrolled agent. So you're going to remember that C. You are C, enrolled agent. So then when you come down here, you're going to put your designation, the C right here, to say you're an enrolled agent. Licensing jurisdiction, you'd put IRS. And then you're going to get an enrolled agent number. When you become an enrolled agent, the IRS will send you your EA number. You would put that here. Then you would sign and date. In this, there are 4 boxes here. You'll remember back on page 1, there were 4 lines to name representatives. And so these correspond to there. So if you've got 4 different people, you do it in the same order. 1, 2, 3, 4. that you did back on page 1. So all of you could just be one person, or it could be 2, 3, 4 people. You could actually have more by attaching more sheets. But how many ever there are would all fill out the relevant information for them. You would all sign and date. And that is the 2848. Again, get yourself a copy of this, look through it, and read through the instructions. The CAF talked about this. What is this centralized authorization file? This is how the IRS keeps track of who has power of attorney for what taxpayers and for what issues and time periods. So when you put in your first POA as a practitioner, the IRS will assign you a CAF number, and then you will use that CAF number in all of your future POAs for all of your clients. So it's not specific to a client, it is specific to you as a practitioner. So this is just a computer system so that once you're in the system, then if you call in, for instance, to the IRS, they're going to want to check to make sure that the person they're talking to has the authority to speak on behalf of the taxpayers. So that's what this CAF system does. So then they will ask you some questions to verify that you are who you say you are, and then they will look you up in the system to make sure that it's okay to talk to you about that particular client. So that's what this is. And then this just mentions that one-time limited authority that we talked about back on the 2848. That's that line 4 checkbox. So if it's just a very small issue of a limited period of time, then they're not going to bother to enter you into the CAF system because they're not anticipating you having to call back and forth. It's just a quick thing that's taken care of with one interaction. No need to put you into the CAF system. So that's when you check that box on line 4. Alternate forms of power of attorney. In the real world, 99% of the time, you're just going to use a 2848. But for the exam, you need to know that you can send in your power of attorney in a different format as long as it contains all of the same information that is in the 2848. And you still have to have a signed statement from the representative, including all of the information that would be on the 2848. And in order to have that entered into the CAF system that we talked about, you actually have to attach a 2848 to this other document. So in other words, maybe the client goes to a lawyer and the lawyer writes up a power of attorney form and they don't use the 2848. That's fine as long as that power of attorney form that they write up has all the same information as the 2848. They can do that. But if you, as the practitioner, want that entered into the CAF system so that when you call, they know that you're okay to talk to them, then you have to go ahead and fill out the 2848. Just the taxpayer doesn't have to sign it because they've already signed the other power of attorney, but you still fill it out and attach it, and you sign that 2848, and then that gets sent to the IRS, and they will enter it into the CAF system. Withdrawing or changing a power of attorney. A power of attorney is valid until it's revoked by the taxpayer or until the representative withdraws. The taxpayer can revoke it. They have to do so in writing. And the way to do it is they just take page 1, a copy of the 2848, page 1, they write revoke across the top, and then they send that in to the IRS. If they don't have a copy of it, then they can just write a letter, a statement saying, hey, I want to revoke this, and send that to the IRS. And then similarly, the way the representative or the practitioner would withdraw is they get a copy of the 2848, they write withdraw at the top, and then they send that into the IRS. And if they don't have a copy of it, they can just send a statement into the IRS. As we said before, a newly filed power of attorney is going to automatically cancel any prior power of attorney that covered the same issue for the same years. So maybe they had a different tax practitioner before that they had given a power of attorney to. So let's say we're talking about their 2021 Form 1040. and they had another practitioner. They had already filled out a 2848, gave that practitioner power of attorney for their 2021 Form 1040. Well, as soon as you file as the new practitioner this new power of attorney, that will automatically revoke that prior power of attorney for that prior practitioner. If the taxpayer does not want to do that, they need to check that box and send in a copy of the prior 2848. Say, hey, I don't want to cancel this. In other words, they want to have both parties have power of attorney for their 2021 Form 1040. And that's up to them. They can certainly do that. But in order to do that, they have to check that box and send in a copy of it. There can also be changes or updates made to a power of attorney. Of course, they have to be made in writing and they have to be signed. And then it says there, if the taxpayer gave the representative authority to add or substitute new representatives, remember where we saw that, then they may do so by submitting the changes in writing to the IRS. That's the representative may do so. So you as the practitioner would just submit in writing saying, hey, we are substituting this person for this person, or we are adding this person as a representative. Form 8821. So this is a very limited authorization, so it does not require a power of attorney. This authorizes a third party, such as a bank, an employer, or another tax return preparer, to receive information from specific years and tax returns. It does not authorize representation. So you might use this if you're going to get a mortgage. The bank might want to get tax information, and you could fill out an 8821 and sign it, giving the bank the authority to receive information. It does not give them the authority to represent you in any way. It just lets them receive information. Third-party designee, you'll remember back in part 1 on the tax return, right above where the taxpayer signs is that little checkbox where they can give a third party the right to discuss the return with the IRS. And as the return preparer, it's nice to have that box checked. So that does give you, as the return preparer, a limited authorization to discuss the return with the IRS so that you can just call and make an inquiry on the client's behalf. It doesn't give you representation rights, but it does give you the right to at least talk to someone at the IRS about that return. And of course, you cannot receive a tax refund check on behalf of the client just because that box is checked. Client privacy. Practitioners are required to keep all client tax return information strictly confidential. It is a crime to knowingly disclose it, and it can be a civil violation even if it's not done knowingly or recklessly. So in other words, you can get sued even if you didn't do it on purpose. So you need to keep your client's information confidential. I sometimes drive my wife crazy because I do the tax returns of some of her family members, and I absolutely refuse to discuss anything about their income, their taxes, or anything with her. And she knows it, and it's kind of a running joke between us because most of these family members would probably be fine with me discussing it with her, but it doesn't matter. If they want to discuss it with her, then they can do that. I'm not going to discuss it with her. They are my clients. I am required to keep that information confidential, and I am going to do so. So you need to be very strict about not sharing client information with anyone. It is no one else's business. If your client wants to share that information, that's their business and that's fine, but you do not share that information. Having said all that, of course, there are going to be exceptions. And so these are the exceptions of when you can disclose tax return information. First is if you have the client's consent. So if the client gives you written permission to disclose the information, then you can do so. And you can see on the list all of the things that have to be in that written permission. So you can read through this, but basically it needs to be very specific and very thorough, and it has to be signed by the taxpayer. So they can't just give you general consent. They have to very specifically say the purpose of the disclosure, et cetera, and so forth, and then they have to sign that. So if they do all of that, then you can disclose whatever information they are allowing you to disclose. There are some other exceptions as well. You can disclose information to a second taxpayer who appears on the tax return as long as the second taxpayer is related to the first, spouse, child, etc., and as long as the first taxpayer's interests are not adverse to the second taxpayer, and as long as the first taxpayer has not prohibited the disclosure. So I'll give you an example. When a married couple files separately, so they're married filing separately, each spouse has to put on their tax return the other spouse's name and social security number. So that means that their name is on your tax return and your name is on their tax return. So you, as the practitioner, can disclose to that other spouse the information from their spouse's tax return, as long as their interests are not adverse to each other. So if they're going through a divorce, their interests are adverse to each other. So in that case, you could not disclose that information. Or if one of the spouses said, hey, don't share this information with my spouse, then you cannot share it with their spouse. But other than that, so if they're just a normal married couple who've decided to file separately, there's no strife between them or divorce or anything like that, and they haven't said, hey, don't share this with my spouse, then you can share that information with a spouse. Other times that you can disclose the information. So no consent is required in these circumstances that are listed here. First of all, if you get a court order or subpoena to show up and bring with you, for instance, tax returns, then you are allowed to do that. Now, in the real world, I would talk to an attorney before I did this to make sure you're not doing anything that is wrong. But you need to know for the EA exam that if you have a court order or a subpoena, then you can disclose that information. Similarly, you have an administrative order from a federal or state agency that is charged with licensing or regulating tax preparers. So it could be that there is an agency that is investigating you as the preparer, and there's some allegation that's been made against you. So you may need to disclose client information in that instance. So if you have a subpoena from that agency, then you can disclose that information. Reporting a crime to authorities. So if you are reporting a crime, you can disclose the information. Again, in the real world, I would be talking to an attorney about this. But for the exam, you need to know that one of the exceptions is that if you are reporting a crime to authority, then you can disclose that information. If you are going through a peer review process, so for example, larger CPA firms are required to have a peer review done, which means a different CPA firm comes in and they review a sample of their tax returns and of their audits and of all the client work that they do to make sure that that firm is following all best practices and industry standards when it comes to the work that they're doing. So as part of that review process, of course, that other firm that's coming in is going to see confidential tax information. So that is allowed. And then the preparer can also disclose things to their attorney or to employees of the IRS in connection with an IRS investigation of the preparer. So in other words, you're allowed to defend yourself as a preparer if there's something going on, whether it's civil or criminal, that you are being investigated, so you can share that client information with your attorney and with the IRS as well. Electronic data. This is becoming a bigger and bigger deal with the IRS. You should follow industry best practices to keep client data secure. You must have, notice the word, must have a written information security plan in place, and you must follow it. So it's not just that you've got a piece of paper, but you have to actually follow that plan. So you do want to know that you have to have that. You want to know it both for the exam and for your own practice, that you have to have this written information security plan. And there are guides out there. The IRS actually has guidelines that you can find for what should be in that plan and how to write it and what you should do. And then, of course, you should always be aware of phishing and other scams that are designed to steal information. Remember, you can be held liable civilly even if you don't knowingly disclose information. So if you become the victim of a phishing scam and someone gets a hold of all your client information, you can be sued for that. So you have to keep your client data secure because you have to keep it confidential. So there are phishing scams out there. There's lots of them, but a very common one is that you will get an email saying, hey, I was wondering if you could prepare my tax returns for the last 2 years. And they will either have attachments that'll say, hey, I've attached my W-2s to this email. And then, of course, what they want you to do is to click on those attachments. And then once you do, there's been a virus attached, and now they've got control of your computer, and they can get all of your information. Or it might say, call this phone number, call me at this number. And then once you call, they're going to try to talk you into doing various things to get access to your data and or to get money from you. Once you become an EA, you're going to have the opportunity to have your contact information and your email address made part of a public database. Once you're in that database, anybody, of course, can get access to that information, including your email. So if you get an email out of the blue from somebody you never heard of that says, hey, we want you to prepare our tax return, call us, or click on these documents, you just need to assume it is a scam. Think about it. Would you just pick somebody out of a database somewhere and send them your tax information and say, hey, I want you to do my return? No. Now, you might want to interview them. You might want to contact them and say, hey, I was thinking about this. But you wouldn't just say, here, prepare my tax return, and hey, here's my W-2s. So if you wouldn't do that, other people wouldn't do that either. Now, if you get an email from somebody that says, hey, I'm friends with Joe, who's a client of yours, and I'm looking for somebody to do my taxes. Can you help me out? Give me a call. Well, obviously, that's a different matter. And you might want to call Joe and say, hey, Joe, I got this message. Did you give my name? And they say, oh, yeah, that's my cousin. I gave him your name. And then you say, oh, well, thank you so much. I appreciate that. I just wanted to make sure it was legitimate. And that gives you a chance to thank Joe and also to verify that the person you're talking to is a real person. Then you can go ahead and you can do that. But if you're just getting an email from somebody you don't know with no reference or anything, just assume it's a scam. I know you're excited if you're just starting your business, you're excited. Oh, I've got a lead. Somebody wants me to do their taxes. But that's what they're counting on in these phishing scams. They are counting on you being excited and you being a little bit greedy and wanting that work. And then you're going to click on something or call somebody that you shouldn't, and you're going to end up being a victim. So again, the IRS is telling you, be aware, don't fall for these scams. Practitioner confidentiality. With respect to tax advice, the same common law protections of confidentiality which apply between a taxpayer and an attorney also apply to a taxpayer and any federally authorized tax practitioner. Now, this only applies in non-criminal matters, not in criminal matters. But that's true even for attorneys. So even for actual attorneys. If that attorney is just collecting the information in order to prepare a tax return, then that attorney-client privilege only applies to non-criminal matters. Now, obviously, if the person is consulting the attorney for a criminal matter, then they would have a confidentiality as well. But if it's just that that attorney is doing their tax return and they're giving them information to do their tax return, then there is no privilege for a criminal matter in that case. And for you as an enrolled agent, that's just the case. There's no confidentiality when it comes to a criminal matter. But in your day-to-day practice, you're not going to be dealing with people who are committing crimes. You're just going to be dealing with normal tax return information. You've got the same rights and responsibilities as an attorney when it comes to confidentiality. So you've got this attorney-client privilege. You've got this tax practitioner-client privilege. So again, everything that is said, all of the information, that is between you and the taxpayer, and that is not to be shared with other people. Then you can see this other exception is also for tax shelters. If it is dealing with a tax shelter, then there is no confidentiality that applies. Now let's move on to talk about preliminary work. So when you are first going to be representing a client before the IRS, what are some of the steps that you want to take? So here's what you want to do. First of all, you need to get the facts and all the documents that are related to the case. So you need to know what is going on. So you're going to do a very detailed interview with the client, maybe with other people that might be potential witnesses or experts in the case. You want to understand what you are dealing with. Then you want to identify the tax issues that are involved. You will consider, are there any criminal aspects to this? And if there are, or if there might be, then the client should be retaining an attorney to talk about those things. Then you want to consider your own competence or expertise. We talked about this in the first video in part 3. You need to be competent to doing the work that you are doing. So you want to make sure if you're getting one of these cases that you are competent to handle that case. And then finally, you want to verify that you and other members of your firm don't have any conflict of interest. Remember, you cannot represent someone if there's a conflict of interest with you or with another client that you have. And so if this is just you and you're a one person firm, well, it's pretty easy to know whether or not there's a conflict. But if you've got several people in the firm, then you need to have some system in place that you can check for any new client that you're taking on, especially if you're representing them before the IRS, that there is no conflict of interest. Some documents that you may want to get. We talked about this a little bit way back in part 1 when we talked about when you're just starting to do a tax return. Of course, there's certain documents you want to get. And it's similar when you're talking about representing somebody before the IRS. You might need canceled checks, bank statements, credit card statements, and the client's own accounting records or other records would be very important as well. So you want to ask the client for these things and get as many of these things that you can that are relevant to the issue that you are representing them for before the IRS. And then there could also be legal documents that you may need depending on the circumstances, birth certificates, divorce decrees, any lawsuits, etc. If they are a business entity, it's probably a good idea to get their documents, their founding documents, whatever those may be. And of course, there can be other things depending on the matter at hand. Copies of tax returns, you're going to want tax returns for the years in question. You may also want to get, it's usually a good idea to get a year or two before the year in question and a year or two after the year in question, because sometimes things carry over between years. So you want to get the full picture. You might need both corporate or other business returns as well as individual 1040. So sometimes you've got a client who also has an S corporation, for example, and it's their 1040 that's being audited. But of course, the S corporation items are going to flow into that 1040. So you may need to also have copies of the S Corp return in addition to copies of the 1040. So you just want to consider that and get copies of whatever returns that you need. If you cannot get copies of the actual returns, then you might get tax transcripts instead, or you might get them in addition to copies of the tax returns. So, what do we mean by transcripts? Well, a transcript gives you a line by line breakdown of what was on the tax return. So, it is not a copy of the return itself, but it shows you what each line that had any information on it, it shows you what was recorded by the IRS. So it's almost as good as having a copy of the tax return. I'd still rather have a copy of the tax return, but having the transcript is almost as good. But sometimes it's not possible to get a copy. The client doesn't have a copy of their tax returns. They just can't find them. So you would want to get a transcript. Other times you may actually have a copy of the return, but it was prepared by someone else. And you want to make sure that what you are seeing on that copy is actually what was recorded by the IRS. So you can get a transcript to make sure that your copy that you're looking at, that all the numbers are the same, so you can be confident that the copy you're looking at is legitimate and is the exact one that was filed with the IRS. You can get these transcripts online. You take advantage of e-services, and I'll show you some screenshots here in a minute so you can see what that looks like. But you can get these transcripts online. So once you have the power of attorney, then it's pretty easy to go in and get copies of those transcripts. If you want an actual copy of the tax return, which is oftentimes a good idea, you can get those as well by filing this Form 4506. Now, you can only go back 6 years, but you can get a copy of any tax return in the last 6 years. There's a $30 fee per return, and you do that by filing that Form 4506. Similarly, by filing the 4506T, you can get a tax transcript by mail. So you can go online and get it, or if you want to, you can file the 4506T and get those by mail, but those can only be sent directly to the taxpayer. They're no longer able to be sent to you as a representative, even if you have a POA. They will only send it to the taxpayer's address. So it's really better to get it online. So this is what it looks like when you go into e-services, which is irs.gov/tax-professionals. When you go there, you're going to see several options, and one of those is Transcript Delivery System, or TDS. And so you can go there, click on that, and get a copy of the transcript. Once you get it, it will look something like this. So you can see it's got basic information at the top, and then it shows you their filing status. It was Form 1040, and then it goes down and actually shows you for each line what were. So here's what the wages were, etc. And it can be a couple of pages long, depending on how much information is, but it gives you a nice summary of what was actually on the tax return. So now let's talk about the taxpayer financial situation. This is very important when you are dealing with the IRS. Their ability, the client's ability to pay, is a very important consideration when you are dealing with the IRS. The IRS knows that they cannot get blood out of a turnip. So if you've got a taxpayer who just doesn't have much money, doesn't have very many assets, doesn't have much income, then you are in a pretty strong position as a negotiator for the taxpayer, because if there's just not much money there, then there's not much there for the IRS to get. But in any case, you need to know your taxpayer's detailed financial situation, their income, their expenses, their assets, their liabilities, etc., because that is going to affect your negotiations with the IRS. So you will want to know, as we discussed, income, expenses, cash flow, assets, liabilities, and potential liabilities. If they're in bankruptcy, that's important to know and have documentation. If they are insolvent, insolvent means that the liabilities are greater than the assets. That's what it means to be insolvent. So they may not legally be in bankruptcy, but they are insolvent. Their liabilities are greater than their assets. You want to know about any garnishments that are coming out of their paycheck, for example, and any lawsuits that they may be involved in. So these things, income, expenses, assets, and liabilities, think back to financial statements, and it's very much that type of information. So an individual usually doesn't have an income statement and a balance sheet, although they can. There are some wealthier individuals who do get those done, but most individuals aren't going to have income statement and balance sheet. Of course, businesses will. So you want to think about that information. That's the type of information that you need. So you need to know all their sources of income. What are their expenses in detail? Not just, well, I have this much each month, but by category. What are their expenses? What are their assets? What are their liabilities? And as it says down here, you may need third-party information such as appraisals, property tax assessments, or state and local tax information. So one of the big differences when you're dealing with a business balance sheet, the asset values on the balance sheet are what? They are what we call book value. So they're the basis. That's what's going to go on the balance sheet as the basis of those assets, which means it's the original cost with any adjustments that have been made. But that original cost may not be even close to the fair market value of those assets. When you are getting your clients financial information for purposes of representing them before the IRS, you need to know their actual financial information. You need to know the fair market value of their assets. So even if it's a business, if it's a corporation, their business's balance sheet may not give you a true financial picture because you want to know what are those assets actually worth. They could have a building on their balance sheet that they purchased 20 years ago that has a fairly low book value, but the fair market value, if they were to sell that asset today, is very large. And it's that fair market value that we need to get at because we need to know what resources does this client have in order to pay any tax bill. And that's going to be based on the fair market value of the asset, not the book value of the asset. As a result, you might need to get an appraisal in order to know what that asset is worth. Property tax assessment may also help with understanding how much that property is worth. But in any case, you need to get detailed listings of your assets, how much they're worth, whatever your liabilities are, and your income and your expenses. When it comes to expenses, the IRS has published collection financial standards that they use because they do not want you or the taxpayer just putting down outrageous expense amounts. So they've got published expense amounts that they use in order to determine what are reasonable expenses for the taxpayer. And what they are going to allow for expenses are living expenses that are considered necessary to provide for the taxpayer's health and welfare and or the production of income. So the taxpayer and their family. So if you've got a taxpayer who's living high on the hog with all kinds of outrageous expenses, they're not going to allow you to take those into account when they're trying to figure out how much money the taxpayer has in order to pay their tax. So for different types of expenses, there are different standards. So the IRS has published national standards to use for food, clothing, healthcare, and other expenses. And the taxpayer is allowed to use those amounts regardless of the amount they actually spend. So if your taxpayer spends more than these published standards, they can only use the published standards. They can't use what they actually spend. But if the taxpayer actually spends less than those published standards, they can still use the published standards. That is for food, clothing, healthcare, and other expenses. It's different when it comes to housing, utilities, and transportation expenses. First of all, for those, there are local standards that are published because they're taking into account that it's more expensive to live in New York City than in Little Rock. So they're going to have different standards for housing, utilities, and transportation in New York City than they are for Little Rock. On the other hand, when it comes to food, clothing, and healthcare, they're not. Doesn't matter if you live in New York City or Little Rock, they're going to be the same. But for these expenses, the housing, utilities, and transportation, they will use local standards that they have published. And in this case, the taxpayer is allowed the lower of the two, the lesser of the published standard or the amount that they actually spent. So up here, they just use the standard no matter if they actually spend more or less. Down here, they use the lesser of the published standard or the amount that they actually spent. If the taxpayer is in bankruptcy, that changes things. So, first of all, bankruptcy stops all assessment and collection efforts. So, the IRS, they may have been sending all kinds of letters and notices saying, hey, you owe this money. They might be threatening to put a lien on property or bank accounts, et cetera, and so forth. If the client files for bankruptcy, all of that stops, at least for the time being. It's put on hold. They are no longer allowed to do that. They can't go put a lien on anything. They're not supposed to send any more letters assessing tax or anything like that. Certain tax debts can be discharged in bankruptcy. Other tax debts cannot be discharged in bankruptcy. The only tax debts that can be discharged have to meet all of these requirements. And you're going to want to remember these for the exam. The taxes must relate to a tax return that was due at least 3 years before the bankruptcy filing. So if the client filed bankruptcy in March of 2023, we have to say what years could be subject to discharge. Well, if you think about a 2019 tax return, it was due April 15th of 2020. So if you are filing bankruptcy in March of 2023, the 2019 tax debt cannot be discharged in that bankruptcy because it was due less than 3 years prior to the filing of the bankruptcy. So you'd be looking then at a 2018 or sooner tax debt that may be eligible to be discharged. But any tax debt that arose in 2019, 2020, 2021, 2022, 2023 cannot be discharged in bankruptcy. In addition, the tax return must have been filed at least 2 years before the bankruptcy filing. So if you had a 2018 tax debt, but they didn't file their 2018 return until 2022, then again, that was not within the last 2 years. So that 2018 tax debt could not be discharged in that case. Also, the tax assessment must be at least 240 days old. So that's what, approximately 8 months. So maybe there was an audit of your 2018 return done, but it was done in this example in late 2022, and the IRS assessed the tax in December of 2022, for example, and now you're filing bankruptcy in March of 2023. Well, that's not at least 240 days ago that tax was assessed, and therefore that cannot be discharged in bankruptcy. Then in addition, the tax return cannot be fraudulent or frivolous. So if you filed a fraudulent return, then all bets are off. You can't discharge the tax, and you cannot be guilty of tax evasion as well. So remember those, particularly these years, the 3 years, 2 years, the 240 days. You want to know those for the exam. Moving on to our next topic, which is legal authority and references. When you are negotiating with the IRS, it's likely you're going to have to do some tax research because there's some issue that is being disputed. And so you're going to want to make your case for your client. You're going to want to be able to say, hey, I think this should be handled this way, which what you think is nice, but it doesn't hold any water with the IRS. So what the IRS is going to want to know, not what is your opinion, they're going to want to know what legal authority are you basing your opinion on. So you're going to want to do research in order to say, hey, here's what the law says, or here's what this court case said, and here are the facts. And so when we apply the law or this court case to the facts of this current situation, this is what the result should be. So when you are doing that tax research, you need to know, first of all, where you're going to look, and secondly, what holds the most weight as far as legal authority is concerned. And so here is the list. It starts with the U.S. Constitution. In the United States, the U.S. Constitution is our top source of any information. And we're going to look at each of these in a little bit more detail. But of course, most of the time, we're not going to be looking at the Constitution to figure out the tax situation. We're going to be using one of these other things, the Internal Revenue Code, regulations, and the other information that you see here. So we're going to talk about each of these in turn, but this is kind of the general order of the authority that these various things have. So you can see the Internal Revenue Code has more authority than an IRS revenue ruling, for example. But a revenue ruling has more authority than a private letter ruling, for example. So this is the rough order of authority that each of these things has. There are also non-authoritative sources. In other words, these cannot technically be relied on when you are negotiating with the IRS, but they can still be very helpful when you are doing your research. So first is the Internal Revenue Manual that we will talk about, and next is IRS forms, instructions, and publications. So we'll talk about these. And then there are these secondary sources or outside sources. So they are third-party research tools, books, databases, etc. So some examples are, these are like the company names, BNA, CCH, RIA, Checkpoint, LexisNexis, Westlaw, and there can be others. So you can use these also when you are doing your research. So let's talk about each of these things in turn. So starting with the Constitution, we talked about this back in part 1. The 16th Amendment to the Constitution says Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states and without regard to any census or enumeration. Again, from whatever source derived. So this is what really gives the IRS the power to tax your income. They had to put this amendment in 1913 because there had been an income tax. Previously, the Supreme Court had ruled that it was not constitutional, so they enacted the 16th Amendment in order to allow an income tax. But again, most of the time, you're not going to be referring to the Constitution when you are trying to figure out a tax position. So, therefore, after the Constitution, the place we really look to as the top of the food chain is the Internal Revenue Code. So the Internal Revenue Code, or IRC, this is the tax law, and it is the foundation of all federal tax authority. As you can see, except for if you've got a tax treaty somewhere, then the tax treaty would rule. But within the United States, the Internal Revenue Code is the tax law, and that's the foundation of everything. And it is codified in Title 26 of the United States Code. You might want to know that. And officially, right now, it is called the Internal Revenue Code of 1986. So every few decades, the IRS, or actually it's Congress will do a major overhaul of the tax code, and then they will rename the code. So the last, what they consider to be major overhaul, was in 1986. So that is what we're dealing with, the Internal Revenue Code of 1986. Trivia question, what was it before 1986? And the answer is it was 1954. So there were 32 years between revisions, but here we are, we're already more than 32 years beyond since the last revision. So who knows when the next major revision to the code will be, but right now it is 1986. After the Internal Revenue Code, the next highest level of authority are the Treasury regulations. So the regulations are issued by the Internal Revenue Service to provide guidance on new legislation or to address issues that arise with respect to existing Internal Revenue Code sections. So sometimes the Internal Revenue Code is not very specific. It gives you the general law, but when you have to actually apply that law in specific situations, you need more guidance. So the IRS will sometimes come out with regulations that expound upon what is in the actual Internal Revenue Code. And the Internal Revenue Code, by the way, actually gives the Treasury Department the authority to write these regulations. And sometimes Congress will actually direct the Treasury Department to write regulations on a particular topic. So even though these regulations are not technically the law, they essentially have the weight of law. So when you are representing a client before the IRS, if you can show a Treasury regulation that says something that applies to your client's situation, that will be given the same amount of respect and weight, essentially, as the Internal Revenue Code itself. Now, when you have regulations, they come in various forms. So when they first come out, they will be proposed, and then they will be offered for public comment. So the Treasury Department will say, hey, here's some regulations that we've come up with. What do you think? Then what happens is interested parties of various kinds will look at those regulations, and then they will make comments back to the Treasury Department or to the IRS. And they will say, hey, we see this, but that could be a problem because of XYZ, or did you think about this? Or we just think that this is bad policy or gives a bad result. And so they can give their opinion. So who gives their opinion? Well, anybody can, but it's usually going to be tax practitioners, can be CPAs, attorneys, enrolled agents. Maybe they've got clients that they're very affected by whatever this regulation is, and they want to look out for the best interest of their clients. And so they would like to see different things in those regulations than what is currently in there. There could also be industry groups. So if a particular regulation is going to have a big effect on a particular industry, then there can be industry groups who are also giving their comments on those regulations. And then the Treasury Department will take those comments into account, and they may or may not make changes based on those comments. You can also have temporary regulations. This is where they want to get something out there and get it out there kind of fast because it's an important issue that taxpayers need guidance on, but they don't go through the whole process yet of making those final. So they put temporary regulations, and they remain in effect for up to 3 years. So that's what you want to know for the exam, is they remain in effect for up to 3 years. What you want to know in real life is that we've got some temporary regulations that have been around for decades that we still actually rely on. You can't officially rely on them, but they're all we have. So there's been no final regulations ever issued. So all we have is the temporary regulations. So we will look to those in order to get guidance on what we want to do in a particular situation. And then you do have final regulations. So this is what we really like to have, is the final word. These are the official ones that can be relied on, and again, are almost as good as the Internal Revenue Code itself. Next thing that you can look at, and what the IRS can look at, and what courts will look at, is legislative history. So before a bill becomes a law, there's a lot of debate in Congress about the law and about why it's needed and what it's trying to accomplish. And much of that discussion and debate is codified in the congressional record, which is a public document, and in other places. And that history can give you insight into what they were thinking. So it's congressmen, it's senators and representatives who are actually enacting the legislation. So it's good to understand what were they thinking, because sometimes they'll put things into words, but the words can be kind of vague. And so looking at the legislative history can help you understand what they were trying to accomplish, and therefore how you should interpret those words that actually ended up in the law. And the courts will very often look at this. If you're ever reading a court case, they will frequently look back to the legislative history to try to get into the minds of the people who are writing the law so that they can help to interpret it. Which then brings us to case law. So this is cases that have gone to court, and when the judges make their decision, they will write up their decision, and that gets published. And so you can go and look at those published cases, and you can see ones that are kind of similar to your client's case, and you can try to apply the same reasoning that the judge used to your client's situation in order to figure out what is the right answer. Now, there is a hierarchy of federal courts. So the U.S. Supreme Court is at the top of the heap. So if the U.S. Supreme Court says something, then that is the final word on that issue. There are other courts below the Supreme Court. You've got various circuit courts of appeals around the country. There's not just one of those, there are several of them. There are also several district courts around the country. Then there is one U.S. tax court. So a lot of the cases that you will read will be from the tax court, I think for obvious reasons. They're dealing only with tax issues. And then there's also this U.S. Court of Federal Claims where some tax issues can come up. So you may look at cases from any of these sources, but you do want to know, like if the tax court ruled something, but then that got appealed and a higher court overturned it, then you need to know that. You need to know that the tax court case is no longer actually valid. You need to then look at the appeals case or the Supreme Court case if it went all the way to the Supreme Court. If you go to court and the IRS loses, they may or may not acquiesce to the decision in future situations. Now, unless it comes from the Supreme Court. If it comes from the Supreme Court, they don't have a choice. They have to follow it. But if it comes from any court other than the Supreme Court, the IRS can just say, you know what? I know that's what that judge ruled or those judges ruled, but we don't agree. And in future situations, we're not going to follow that. We're going to follow what we think is right. So then future taxpayers, if they want to change it, they're going to have to file another case and go to court and see what the judge says in that case. And there are many instances where the IRS simply disagrees, and so they will not follow the court in that case. Now, if you're representing a taxpayer, I would still bring that case up because they could follow it, even if they haven't officially acquiesced. When you're negotiating with them, they might agree to follow that case anyway. So you're going to want to know about it, but you're also going to want to know that they might say, well, I know that's what that case says, but we don't care. We are not following that. Next, we get down to IRS positions that are taken. And you've got these various things: revenue rulings, revenue procedures, private letter rulings, and technical advice memoranda, IRS notices and announcements, the Internal Revenue Manual, and finally, IRS forms, instructions, and publications are at the bottom of the heap here. So IRS revenue rulings and procedures. So revenue rulings apply the law to a given set of facts, and taxpayers with similar facts can rely on them for guidance. So they will come out. The IRS will see that there's an area where there's a lot of questions and there's a lot of disputes about how it should be handled. So what the IRS will do is they'll come out and oftentimes they'll take an actual situation And they, of course, won't tell you the actual name of the parties involved, but they'll give you the facts. And they'll say, here are the facts, here's what happened. And then they will say, here's how the law applies. And this is the official IRS position on how to apply the law to those facts. That is an IRS revenue ruling. And again, those have a lot of authority. If you're dealing with the IRS, with your taxpayer, well, this is their own ruling. So if their own ruling says this is how it's supposed to be handled, that's going to carry a lot of weight. Then you have revenue procedures. So those announce administrative practices and procedures for complying with the law, and they may also be relied on. So for example, there are inflation adjustments every year that we've talked about, these dollar amounts that increase each year. Well, how do those dollar amounts get announced? Through a revenue procedure. So every year there will be a series of revenue procedures that say, these are the new dollar amounts for next year. So like in the fall of each year, they will announce the inflation adjusted dollar amounts for the following year. And that's done through a revenue procedure. And there are other things that are also done through revenue procedure. So this is sort of the nuts and bolts of how do you actually deal with the tax return and deal with the system. Those types of things are done through revenue procedures. Both rulings and procedures are numbered by the year issued, followed by the sequence that it was issued in that year. So the first revenue ruling for 2024 is revenue ruling 2024-1 and -2 and so on. In same way with revenue procedures, it'll be revenue procedure 2024-1. Sometimes we call that Rev Proc. That's the way we say revenue procedure. And then the Rev ruling, we usually just say Rev ruling or something like that. But that is how they are numbered when you see those. Next are private letter rulings and technical advice memoranda. So a private letter ruling is when a taxpayer writes to the IRS. They actually have to pay money in order to get this done, but they have an issue that they're not sure how to handle, and they want the IRS to give a ruling on that issue for them so that they can confidently file their tax return and know that what they are doing is right and is not going to be questioned by the IRS. So they submit to the IRS all of the facts and circumstances and all of the law that they think that applies, and they say, hey, IRS, what should we do in this case? And then the IRS will come back and they will say, well, in your case, this is what you should do. Those are published. Of course, again, they're not published with the actual taxpayer's name or anything like that, but these are published and they are something that you can go and look at to get an idea of what the IRS is thinking. They technically cannot be relied upon by other taxpayers. So we'll actually say, when you read one of these, it will actually say, this ruling applies only to this taxpayer in this situation and cannot be relied upon by other taxpayers. So it actually says that in the text of the private letter ruling. However, it gives you a very good indication of how the IRS thinks about that particular issue. So if you can get one or more private letter rulings that have facts similar to the facts that your client has, then that can give you a pretty good level of confidence about how you are supposed to handle that issue. Similar are technical advice memoranda. This is kind of the same thing, except instead of the taxpayer asking for the ruling, this is the IRS themselves asking for the ruling. So you're going to have a local IRS office who's got a taxpayer that's under audit, and they're trying to figure out, hey, how should we handle this issue? They can send that to the IRS Office of Chief Counsel with all the facts and everything, and they can say, how should we handle this? And then the Chief Counsel's office will write back to them and say, here's how you can handle it. And again, they get published, and again, they are only applicable to that particular situation. You can't rely on them officially, but again, it gives you an insight into how the IRS thinks about the issue and how it may apply to your case. Next are IRS notices and announcements. So an IRS notice is a public announcement that may contain guidance involving interpretations of the Internal Revenue Code. These can be issued very quickly. So regulations can take a long time to come out, but notices they can do pretty quickly. And so they can give you some guidance, but they don't have as much weight and authority as, for instance, regulations have, mainly because the IRS hasn't had as much time to kind of think about it and to formulate what they want to do. So they may change their mind later. They may issue an IRS notice and then later on take it back or issue a new notice that obsoletes the first notice. But again, absent any other guidance, this might be all you have. And so usually, again, if you're representing a taxpayer, if you've got an IRS notice that applies to the situation, that usually will hold a lot of weight with the IRS, and they will pay attention to that. IRS announcements are even shorter term, so it only has immediate and short-term value. So a lot of times this will be an extension of an impending deadline. So you've got a normal tax deadline is April 15th, but there's just been a natural disaster in a particular part of the country. So they'll say that those people in that part of the country that are affected by that natural disaster, they get an extension till whatever, June 15th maybe, to file their return, whatever it may be. That type of thing will be made in an IRS announcement. Then we get to the non-authoritative sources. In other words, these are not things that you can say, hey, IRS, you have to rely on this because you said it here. The other things you can say, look, this was in the IRS notice. This is what it says. You need to follow this. And the IRS generally will. These are sources they do not have to follow. That doesn't mean, though, that they're not helpful, especially for giving you insight into the IRS. So first is the Internal Revenue Manual. So this is really designed mostly for IRS employees themselves. It sort of helps them to know, like, okay, if you are out auditing a taxpayer's tax return and you've got certain issues to come up, here's what you want to look for and here's what you want to think about. So the Internal Revenue Manual, it consists of 39 parts, and it is a public document. You can find it at irs.gov/IRM. So you might just want to go and have a peek at that. Not that you have to know it for the exam, but it's just kind of interesting to see the different types of issues that come up and what they say about those issues. So when you are doing your research, you can look at that Internal Revenue Manual to give you an idea of what you might want to do for your particular client. Next are IRS forms and publications in the form instructions. And you've seen these already as you've gone through this course. The publications try to explain the tax law and the rules in a kind of easy to understand format. Same way with the form instructions. So these are not authoritative. You can't go to the IRS and say, well, it says here in the instructions this, because those instructions, again, they're kind of a somewhat simplified version of the law. They are not the law itself. So they might point you to the law. You might read the publication in order to know, okay, what code section applies here, what regulation applies here. But when you're dealing with the IRS, you don't want to quote the publication. You want to go back to the law or the regulation or the IRS notice, and you want to quote that instead of the publication. And then the irony here, of course, is that even though the publications and the forms and the form instructions are not authoritative, the enrolled agent exam is based primarily on those publications, forms, and instructions. But when you are representing a client before the IRS, you can use those things to guide you, but don't quote them, quote a higher level of authority. Next, we have those secondary sources that we talked about. Of course, they are not authoritative, but they can help you when you're doing your research. They can help point you to where you should be looking for authoritative sources, and they can just make it easier to understand. So they're not having to use all the legal, formal language that the IRS sometimes uses. They can make it a little simpler to understand. And so you can subscribe to these various ones. You usually don't subscribe to all of them. You'll pick one that you like and you'll subscribe to that. And then that can help you do your research and to understand what is going on with a particular issue. There's also this other one called the Tax Book that I like to use. This is usually for practitioners who are dealing with smaller type of clients and individual clients. It's kind of a nice summary. And again, it will point you to where you need to look for greater authority, along with giving you kind of simplified explanations. The Internal Revenue Bulletin, or IRB, we talked about this a little bit before in the first video of part 3. This is what the IRS uses for announcing official rulings and procedures of the IRS. So when they put out a new revenue ruling, revenue procedure, etc., they will announce that in the Internal Revenue Bulletin. This is published every week. It's also used for publishing Treasury decisions, executive orders, different legislation, court decisions, and other things that are related to the Internal Revenue Service. And this is also where those practitioners' censures, suspensions, and disbarments are published. So remember, we said in the last video how if you get censured or you get suspended, that gets published in the Internal Revenue Bulletin. This is where that is published. So if you want to go and see who has been suspended lately, you can go back and look at the IRB to see their names published there. Tax treaties. The U.S. does have tax treaties with a number of foreign countries. And so what this does is it affects the residents and citizens of those countries and how they are taxed for U.S. tax purposes. It does not reduce the United States taxes of United States citizens who happen to reside in that foreign country. What the tax treaty does is it affects the citizens of the other country when it comes to their U.S. taxes. There'll be some agreement between the countries about how income will be taxed for residents of either country. Many times, though, those treaty provisions are reciprocal. So if you've got a U.S. citizen that has income from that other country, then they may have lower taxes to that country due to the treaty, but it's not going to lower the United States taxes. Now let's talk about some issues related to representing taxpayers before the IRS. First is the statute of limitations. So this is very important. You're going to want to know all of this for the exam. So a statute of limitations is the time period established by law during when the IRS can review, analyze, and resolve your tax-related issues. When the statutory period expires, the IRS can no longer assess or collect additional tax or allow the taxpayer to claim a refund. So it kind of works both ways. Once the statute of limitations is over, the IRS can no longer come after you, but you can no longer go back and amend your return in order to claim a refund either. So there's 3 categories that you're concerned with when it comes to statute of limitations. The time that the IRS can assess a tax, that means the time they can determine that you owe tax and sort of send you a bill. The time that the IRS actually collects the tax. So just because they're assessing the tax doesn't mean they're collecting it at the same time. Those can be 2 different time periods. And then finally, the time that the taxpayer can claim a credit or a refund. So we've got different statutes of limitations for each of those. So let's talk about them. The time that the IRS can assess the tax. So it's usually the later of 3 years after the return was due, including extensions that were granted, or 3 years after the return is filed. The later of those 2. So example 1, Aaron files his 2023 Form 1040 on March 31st of 2024. The statute for the IRS to assess tax ends on April 15th, 2027. So even though he filed it on March 31st, it wasn't due until April 15th. Therefore, the IRS has 3 years from April 15th in order to assess tax for that 2023 tax return. Example 2, Byron files his 2023 Form 1040 on November 30th. So in that case, the statute to assess tax is November 30th of 2027. So even though it was due on April 15th, maybe he got it extended to October 15th, but even so, he didn't actually file it until November 30th. So it's the later of, so therefore they have until November 30th of 2027. So remember that 3 years the IRS has to go back and assess tax. There are, as there often are in the tax law, exceptions to the 3-year assessment date. First of all, if you don't file a return, then the statute never starts, and therefore there is no statute of limitations. So the statute does not start until you file your tax return. So if you've got a 2023 tax return that you haven't filed yet, then the 3-year statute of limitations has not started yet and will not start unless and until you file that tax return. If you filed the tax return, but you omitted 25% or more of your gross income from the return, then the statute doubles to 6 years. So if you omitted, unintentionally, we'll assume, 25% or more of your gross income from the return, then that statute is going to be 6 years from the date that that return was filed, rather than the 3 years. If you filed a return, but it was a false or fraudulent return, then there is no statute of limitations. So if you committed tax fraud, it doesn't matter how old the return is, no statute of limitations. They can go back as far as they want. So they might, for instance, discover a tax fraud from the year 2020. And then when they do that, that piques their interest, and they go back and they start looking at 2019 and 2018, et cetera. They can go back as far as they want if you committed fraud in that year. So if you've been committing this fraud for years and years and years, they can go back 10 years or whatever to when you started committing the fraud, and they can assess tax for every year that you committed that fraud, along with penalties and interest. So obviously that can really add up. Then also the taxpayer and the IRS can agree to extend the time to assess tax. This could be something you are involved with. If you are representing a client for an audit, it could be that the statute of limitations is about to expire. So as part of your negotiation with the IRS, you may both agree, okay, we will extend that time. So it's supposed to be up here on April 15th, but we're still actively negotiating, so we will agree to extend it another 30 days or 60 days or 90 days or what have you. So as long as you both agree, then they can extend that time. This time limit is suspended in a couple of different situations. If the IRS issues a notice of deficiency, otherwise called a 90-day letter, or if the taxpayer files for bankruptcy. So the time is suspended. So what that means is, let's say it's been 2.5 years and the IRS has done an audit and they issue a notice of deficiency. Well, now that 2.5 years kind of stops. It's frozen in time because the IRS has, in fact, met the 3-year statute of limitations. They've issued this notice of deficiency. So now we're going to suspend that time until that notice is dealt with and has a final disposition to it, in which case the time limit may start back up again from 2.5 years going forward another 6 months. Similarly, if the taxpayer files bankruptcy, let's say it's been 2.5 years, now the taxpayer files bankruptcy, well, the IRS is not allowed at that point to go in and do any type of assessments. So again, this time period is going to be suspended until the bankruptcy is discharged, and then that time period will start up again, and you'll finish out your 6 months or whatever it may be. Now let's talk about the time for the IRS to collect the tax. So we've been talking about when they can assess it, so when they can basically determine that you owe the money and send you the bill. But what about actually collecting it? Well, they generally have 10 years from the date the tax was assessed in order to collect the tax and any associated penalties and interest. So you want to know that for the exam. They've got 10 years from the date of the assessment in order to collect it. But of course, there are certain situations that can extend or suspend that time. If you've entered into an installment agreement, it can go beyond the 10 years. Again, if they file for bankruptcy, it can suspend that time. If you enter into an offer in compromise, then you can extend that 10 years. If the taxpayer has requested a collections hearing, that will suspend this time limit. If you've requested innocent spouse relief, that will suspend it. Military service could suspend the time. If you're off on military service, you're not able to be there for meetings with the IRS, that can suspend the time. And living outside of the United States can also suspend that 10-year time period. What about the taxpayer? How far can they go back in order to claim a refund? Well, generally, the latest taxpayer can request a refund is the later of 3 years from the date the tax return was filed or 2 years from the date that the tax was paid. And if the return was filed before the due date, then it is considered filed on the due date. So again, if you filed your return on March 31st, it will be considered that you filed it on April 15th. So you're going to have 3 years from April 15th in order to amend that return and request a refund. So it's the later of those two things, 3 years than the date it was filed, or 2 years from when the tax was paid. So again, you want to remember that for the exam. And the exceptions to the 3-year, 2-year rule. No rule would be complete without exceptions. That's what I say. So here are the exceptions. If you are claiming a refund due to a bad debt or a worthless security, then instead of 3 years, you've got 7 years from the return due date. If you are affected by a presidentially declared disaster area, you get 1 additional year. If you were serving in a combat zone, you can have more time to file depending on how long you were in that combat zone. And again, you can agree with the IRS to extend this time to assess the tax. So those are the exceptions. The big one you want to remember is if it's a bad debt or worthless security, you have 7 years rather than 3 years. Amending a return. So we have talked about this previously, but let's go over it again. If you discover an error in a return that was already filed, then you can amend it as long as you are within the statute of limitations. Again, if the return is filed before the due date, it's considered filed on the due date. Filing an amended return does not extend the statute of limitations for the IRS to audit either the original nor the amended return. So this is one that trips a lot of people up. Sometimes people think, well, if I file an amended return, let's say you file the amended return 2 years after the original return, they think, well, now the IRS has got 3 years from when I filed the amended return in order to audit the amended return, but that is not the case. The IRS still has to follow the original 3-year rule. So they still have only got 3 years from when the original return was filed in order to assess tax for either the original return or that amended return. Now, there's this one little exception that says if you file that amended return within 60 days of when that statute of limitations is expiring, then the IRS has 60 days from the date filed to assess the tax. But they still have only got 60 days. So you just filed this amended return. So this is all new information to the IRS. They don't get another 3 years. They only have until the statute expires or 60 days if you filed the amended return within 60 days of when the statute expires. If you owe tax, then the normal IRS assessment statute of limitation still applies. So they still only have 3 years. So if you go back and amend a return that was from more than 3 years ago, and you send in a check to the IRS because you owe money, don't be surprised if they send that check back. Because even though you owed them money, if it's outside of the statute of limitations, the IRS cannot accept that money or that amended return for that matter. They are going to send it back to you because they can no longer assess tax. Now let's talk about post-filing correspondence. In other words, you've already filed a tax return and now you're getting some sort of letter or notification from the IRS. And so this can be done for a number of reasons that you see there on your screen. Could be that you've got a balance due and you didn't pay it, so they're going to send you a letter reminding you that you didn't pay it. Could be that you are owed a larger or smaller refund. They may just have a question about something on the return. They want to verify your identity. They just need additional information. They've made a change to the return. So if you make some sort of mathematical error, they might write to you and say, hey, you made an error. We corrected it. You don't have to file a new return or anything. They just want to let you know that they corrected it and here is the result. And they may also give you a notification of any delays in processing the returns. So anytime you get one of these letters, here's what you need to do. First of all, you need to read it very carefully. Details matter. So you want to be very detailed oriented when you are reading these letters. And then you want to respond if necessary. And normally the letter will tell you what your options are. And if you want to respond, it will tell you how to respond. It'll give you an address to write to. And so then you will do that if you need to. If you agree with the letter and you owe money, then you need to pay whatever amounts are due or contact the IRS to arrange some sort of payment plan. And of course, you want to keep a copy of the notice. If you disagree with what they say, then you are going to respond to the letter and say, here is why they disagree. And you want to make as compelling a case as you can for why what they are saying is not correct. And sometimes the IRS just messes up. They just make mistakes and they will send a letter saying you owe all this tax when in fact you do not. And so a lot of times your clients are going to ask you to respond to that. So again, you have to have a power of attorney. You can send the power of attorney in with your response, but you have to have a power of attorney. And then you can respond to that letter and get that issue resolved. Deadlines and timeliness requirements. As you have seen throughout this course, the IRS has deadlines for just about everything. For filing returns, for responding to notices, for filing for refunds, etc., and so forth. And so you want to follow those deadlines. They have to be adhered to. If not, you're going to risk interest, penalties, or even non-acceptance. They might just say, sorry, we will not accept this filing or this response to our notice. It's too late. Now, there can be exceptions. Those are usually published in advance, such as after a natural disaster. And there are some areas where the IRS does have some flexibility to grant extensions, but those are exceptional cases. And most of the time, they do not have that flexibility. So you want to pay very strict attention to those deadlines and make sure that you meet them. Freedom of Information Act requests. You're not going to come across this very often in actually dealing with clients, but they might ask questions about it on the exam, so you need to understand what it is. So this was enacted in 1966. It's the Freedom of Information Act, or Foya, we call it, and it gives any person a right to certain information and documents from the federal government, including those of the IRS. But of course, private taxpayer information is never going to be available. So somebody can't go and ask for the tax return of some famous person or something. They're not going to get that. And anything that is related to ongoing criminal investigations and other sensitive information will also not be released via a FOIA request. There's many records that have already been made public, and they're part of online databases that are maintained by the IRS, so you don't need a FOIA request. And if you want to make a FOIA request, you can do that online at this portal. And there may be a fee if you want actual paper copies of the records. So most FOIA requests are made by journalists who are trying to get information, but anybody can make such a request. And what you want to know for the exam is that private taxpayer information is not available, nor this other sensitive information. Voluntary tax system, you will sometimes hear our income tax system referred to as a voluntary tax system. And you might think, well, it doesn't seem very voluntary to me. So what does that mean, a voluntary tax system? What it means is that taxpayers self-report their income and pay their tax. So it is not forcibly taken from you. You report how much income you had on the tax return and you voluntarily pay your tax. Now, having said that, if you don't voluntarily comply, the IRS has the authority to come in, assess, collect the tax due, seize your bank accounts and your other property, and do all of those other things. So it is technically a voluntary system, but this is what they mean by a voluntary system. It doesn't mean that you can just decide, I don't want to pay taxes. That is not what they mean by a voluntary tax system. Tax avoidance versus tax evasion. This is important to understand the difference. Tax avoidance is perfectly legal, and we all do it all of the time. A big part of your job as a tax professional is helping your clients to avoid tax. If you do something as simple as participate in an employer's retirement plan or set up an IRA, then you are avoiding tax. That is tax avoidance. There's many, many things that you do to avoid tax, and you are allowed to do those. Congress oftentimes wants you to do those things. That's the reason they put it in the law in the first place, is they are trying to get people to act in a certain way to help spur the economy. And so tax avoidance, perfectly legitimate, perfectly legal, and you will actually get paid money by clients to help them to do this, and that is great. Tax evasion, on the other hand, is a crime. So this is when taxpayers are not paying their taxes that are legally due, and tax evasion is a felony. So a big difference between tax avoidance and tax evasion. And so you'll want to know that distinction for the exam. The Taxpayer Advocate Service. This is an independent organization within the IRS. They help taxpayers resolve problems with the IRS and also to protect taxpayer rights. They are your voice of the IRS, and their services are completely free, and there is at least one taxpayer advocate office in every state in the United States. So if you get hung up on something with the IRS and you feel like you're banging your head against a wall and nobody's listening to you and you're caught up in the bureaucracy, then it can oftentimes be very helpful to go to the taxpayer advocate to get their help. So they will generally help taxpayers when any of the following apply. The problem that's being faced is causing a financial difficulty to the individual, their family, or their business. The taxpayer is facing an immediate threat of adverse action. So maybe the IRS has said, hey, we're going to put a lien on your property. We're going to put a lien on your bank account. And the taxpayer or you as a representative are trying to deal with the IRS and you're just not getting a response, or they're just not being cooperative. You can go to the taxpayer advocate to try to get help. Another situation is that you've repeatedly tried to contact the IRS, but no one has responded, or they haven't responded by the date that was promised. Again, you're dealing with a government bureaucracy, and sometimes things can be slow and they can be frustrating. Taxpayer advocate can help with that. Or also, if there is an IRS process, system, or procedure that just isn't operating the way it was intended to operate, you can go to the taxpayer advocate for help. I have used them in the past, and they can be very helpful. They can't do magic, but sometimes it seems like they can do magic, and they can't help you in every single situation. If you're just wrong and you've gone through all of the steps with the IRS and you just owe the money, they're not going to get you out of owing the money. But if you are having a legitimate issue in dealing with the IRS, the taxpayer advocate can be very helpful in that regard. This leads us to the Taxpayer Bill of Rights. Again, this can be on the exam, so you want to know what this is. So there are 10 fundamental rights that every taxpayer has interacting with the IRS, and they are on the screen. The right to be informed, the right to quality service, the right to pay no more than the correct amount of tax, the right to challenge the IRS and to be heard, the right to appeal any IRS decision, the right to finality. So to know that once you've dealt with an issue, that it's over and the IRS isn't going to come back at you again on that same issue. The right to privacy, the right to confidentiality, the right to retain representation. So that's the right to hire you as an enrolled agent to represent them. The right to a fair and just tax system. So these are the 10 things that are part of the Taxpayer Bill of Rights. You don't have to remember them word for word or anything like that, but you want to read through them and remember that, okay, yes, these are the rights that the taxpayer has. Taxpayer identity theft. So this is becoming more and more of a problem. So this is when someone steals your identity and your personal information in order to commit fraud. So your taxes can be affected by this if your Social Security number is used to file a fraudulent return or to claim a refund or a credit. So if a taxpayer believes that someone may have used their Social Security number to file a fraudulent return, they should notify the IRS right away, and they do it by submitting this form 14039. If their e-file has been rejected because their Social Security number has already been used, they should file a paper return and attach a form 14039 to it. So here's what happens. We all know about identity theft. We all know that a lot of our personal information, probably a lot more than we would like, is out there somewhere in the recesses of the dark web. So criminals will get a hold of your information, sometimes even your Social Security number, and they will file electronically a bogus tax return with your Social Security number. And of course, that bogus return is going to have a large refund, and they're going to direct that refund to their bank account. Once they have filed electronically with your Social Security number, if you then go try to file your own legitimate return, it's going to be rejected because the IRS computer is going to say, hey, there's already been a tax return filed with this Social Security number. You can't file another one. So when that happens, you're going to have to file your return on paper, and then you're going to attach this form 14039 to your return in order to say, look, my identity was stolen. And then the IRS will send you a PIN number to use in future years. So that means that next year and the year after and the year after, in order to file a return using your Social Security number, whoever files it is also going to have this PIN number, and they will send you a new one each year. So they'll send it to you in the mail, you get that letter, and then when you file electronically, you put in that PIN number. This is another reason I like to tell clients it's better to file sooner rather than later. So if you can file your return in February or March instead of waiting to April 15th, then maybe you'll file it before the fraudsters tries to file it with your Social Security number. And then if they do, they'll get rejected because the return's already been filed. But if you are a client is a victim of this, this is how you handle that. And that is the end of video 2. In the next video, we're going to talk more about representation. We're going to get into specific areas of representation before the IRS and how those work and how you should handle them. In the meantime, keep studying Circular 230. Keep studying that Publication 947. Look at the 2848 and the instructions for the 2848. And I will see you on video 3.